Good morning and welcome to the first OneAscent market update of 2021. Before we jump into our agenda, let me open us with a brief word of prayer. Heavenly Father, thank you for this new day. Your word tells us that you are making all things new, that ultimately you will bring forth the new kingdom and the new earth, the new heavens and the new earth. Lord, you give us glimpses of that. As we start a new year, we come into 2021 with our hopes and our prayers and our dreams and plans. Lord, may 2021 be a year that is marked just by humble reliance upon you. Lord, we thank you for each person and family represented on this call this morning, and just ask that throughout the course of this year that your will be done. Lord, thank you for this time that we have together this morning. We pray that you would use it to inform, to educate, to equip, to encourage. Lord, all of those things. Be with us now in your son's name. Amen. Well, again, good morning and welcome to OneAscent's market update for Q1 2021. My name is Cole Pearson. I'm the Vice President of Investment Solutions here at OneAscent and will be your host for today's call. Just by way of agenda, I will provide a few updates briefly from the perspective of our investment committee, and we'll spend the majority of our time today hearing from Bobdahl of Nuveen Asset Management. He'll share his investment outlook and his 10 predictions for 2021. If you have questions throughout the call, you may submit those by email to info@oneascent.com, and we'll be monitoring those and get those answered accordingly. And just by way of scheduling, this call we hold on the third Tuesday of every quarter at 10 a.m. Central Time. So go ahead and mark your calendars for those next few. That'd be April 20th and July 20th at 10 a.m. Central Time. Well, I think it's no secret we were all anxious to get into 2021, and it has started with a whirlwind. I wanted to share a few principles. These are really timeless principles, but they are especially applicable for us in 2021. I have the privilege of hearing lots of the questions that clients pose to our advisors across the country, and so we put out these comments in a recent trade commentary, but I wanted to share them again here with you this morning. The first principle is that markets are dynamic and evolving, much more complex and affected by many more factors than simply which party is currently in power. We know that tomorrow is a big day with the inauguration. We must remember that the market doesn't stop just when your party or party of choice is not in power. So markets continue to evolve. Secondly, companies and businesses are incredibly creative, constantly developing new products and services, adapting to operate against ever-changing political backdrops. At the end of the day, what drives our performance in the long run is companies creating products and services that bring value to our citizens, to consumers, and that's not going to stop either. Thirdly and finally, in the long run, it is policy, not politics, fundamentals, not feelings, and valuations, not headlines, that impact the market most. We'll save most of the market commentary for Bob and his time, but wanted to just begin with a few reminders of some of these key principles as we move into a new year. With the start of a new year, it's always helpful to sort of think back and reflect, go back to the basics, remember why we do what we do, how we do it, what it is that we're focused on. So I wanted to do that with you guys this morning. I know we have several first-time listeners for these calls, so I wanted to go back to the basics for the OneAscent Investment Solutions. And that all begins with our investment philosophy. This is the framework that shapes how we think about and view investments. Our investment philosophy has three key pillars, the first of which is values-based. We believe that aligning your investments with your personal values is a wise approach to investing. We have lots of other resources and commentary on this specific point on our website, in different seminars and events that we put on. If you'd like to learn more about that, I encourage you to speak with a OneAscent advisor about what that might mean for you. The second pillar of our philosophy is long-term. We maintain a long-term focus, both in investment analysis and the management of our business. And thirdly, globally diversified. We invest across multiple markets and asset classes to mitigate risk and enhance potential long-term return. So those are the principles, the key sort of pillars that shape how we view the world. If you're new to this call, though, I want to remind you sort of two groups that you need to know about, how our investment team works for you. That first group is the OneAscent Investment Committee. This group of individuals is responsible for the management and supervision of all of the OneAscent investment solutions. They're responsible for functions like setting strategic and tactical allocations, evaluating managers, and monitoring our portfolios. The second group are those managers. We work with third-party managers from around the country. When we're looking for managers, we're specifically looking for demonstrated expertise in a respective asset class or a category. We want our managers to comply with our values-based policies and process, but then also be excellent in their specific part of the portfolio. And so normally in these calls, we have highlight several of these managers throughout the course of the year in our manager spotlight. So if you tune in, if you've listened to previous calls or tune in the future, you'll hear from some of these managers. So that's our philosophy, our team. Now, how does this actually work? We have lots of different ways that you could use a OneAscent investment solution. The most common are what we call our risk-based asset allocation models. We offer a series of 5 different risk-based portfolios, ranging from conservative to aggressive. And I would encourage you, if you are a client or an investor, I would encourage you to speak with your advisor about which one of these portfolios might make most sense for you in your situation. But the core is a risk-first, risk-based approach. We then have to be able to navigate the ups and downs of the market, of course. So our portfolios are specifically built with 2 key components. The core of each portfolio, the largest portion of each portfolio, is the strategic. You can think of that as the roadmap. It's the plan. We update this annually. We use capital market assumptions to arrive at those allocations. And the purpose in the portfolio is risk-based market exposure. This is what differentiates a conservative approach from a more aggressive or growth approach. The second component is the tactical. You can think of this as the navigation. If the strategic is the roadmap or the plan, and you're trying to get from San Francisco to New York, somewhere along the way, you might have gotten off course, and you need a way to get back on course. And that's what our tactical component does. We update that every month. It is an objective assessment of the health of global markets, and the goal it plays is something called behavioral alpha or risk mitigation. When we put these two together, that tactical component allows you to avoid potentially ill-timed decisions. That tactical component can get aggressive when it needs to. It can take risk off the table when it needs to, and allows you to stick to your plan for the long term. So that navigation, that tactical component, we've actually built into what we call our Navigator Process. And so I mentioned that it is an objective assessment of the health of global markets. These are the 4 lenses through which we look at the world. We look at valuations. We look at the economy. We look at sentiment, technical factors. We take all of these things into account. Our investment committee reviews this data, the same data in the same order, week after week, and this allows us to assess comprehensively what's going on in the world, what's driving markets. This is just a snapshot of our current outlook. Again, we'll save most of these comments for Bob's time, but you can see it's sort of a mixed bag. There are parts of this data that we view as slightly positive, others like valuation as slightly negative, and the economy perhaps more neutral, kind of a wait and see type approach. But what this process allows us to do is ultimately get to here, where we are able to rank different asset classes or parts of the market against each other, allowing us to see where there might be opportunities for us as investors. So here you can see just sort of a composite from Q4 till now, till last Thursday. On the left-hand side are the different asset classes or parts of the market that we invest in and that we monitor. And you can see how they rank and how that's changed over time. Currently, some of the top-ranked asset classes in our process, looking again at valuation, the economy, sentiment, and technicals, the top 4 would be emerging markets, international, and U.S. SMID value and U.S. SMID growth. All of this ultimately amounts to the overall allocation. If you remember, one of our key principles in our investment philosophy is global diversification. So here again are our 5 risk-based portfolios and how they are allocated and globally diversified. across that spectrum of risk. Let me zoom in for just a moment to give you an example. Moderate is where we tend to find most clients or investors tend to fall out on that spectrum. Currently, the moderate portfolio is allocated 70% into equity or stocks, 30% into fixed income or bonds. And specifically, you can see we have larger allocations than perhaps normal in some of those areas that we find particularly attractive. Areas like U.S. SMID growth or U.S. SMID value, international, and emerging markets. If you'd like to see more about where your specific portfolio is allocated, again, I would encourage you to speak with your OneAscent advisor and they can review that with you. All of this ultimately leads, hopefully, to performance. And so I'll finish my portion this morning with just an update on performance. Again, what we're showing here is our model allocations. Each model, there's 3 rows to point out. There's the performance of the OneAscent allocation. Each portfolio is benchmarked against a risk-based benchmark, and then you can see the plus or minus against that benchmark. We are very pleased through the end of 2020 how all of our models have performed. Actually, every single one of our turnkey models outperformed its benchmark for the year. Because this data is as of 12/31, the year-to-date and 1-year time periods are actually the same. But just to give you some examples, if you can see my laser pointer moving, the equity allocation year-to-date for 2020 returns 25.1%. That compared to its benchmark at 15.8, amounting to 9.3% of outperformance. You can see how that compares to some broad market indices down here. The S&P, for example, which is an index that is U.S. focused, large cap stocks returned 18.4% for the year. So we've been very pleased with how our models have performed, not just in 2020, but also in the long term, the 3-year and since inception numbers, which are not shown on this slide. The last sort of group of portfolios I'll mention on performance are what we call our retirement portfolios. We manage a series of funds that are specifically designed for retirement plans. These are for 401k plans, for 403b9 plans, for churches or other ministries. Everything that we do is values-based. We've taken these strategies and put them onto a target date approach. So 2020 or 2030, 2040, whatever it is that that participant of that plan would be targeting retirement. These funds, the funds themselves actually launched in February of last year, but we've been maintaining the strategy for almost 4 years now. And so again, just like our turnkey models, for 2020, 3 of the 4 outperformed their benchmark, and sometimes by wide margins. But on the longer term track record, the 3 and since inception, every single one of these retirement portfolios is also outperforming its benchmark. We hope that what this amounts to is not just that we have a smart group of individuals making decisions, but also the fact that by aligning your values with your investments, you can actually achieve 2 outcomes of values alignment as well as the financial returns that you are looking for. So with that, I'll remind you, if you have questions throughout the call, you may submit those by email to info@oneascent.com, and that'll lead us into our time with Bob. Bob, thank you for being with us this morning. Are you there?
Yes, sir. My privilege.
All right. Well, I will turn it over to Bobdahl of Nuveen Asset Management. He actually manages our large cap series, OneAscent large cap core, growth, and value portfolios that contribute to the performance that you've just seen. So Bob and his team are actively involved in managing those portfolios, and we are grateful to have Bob as a partner. Bob, with that, I'll turn it over to you for your 10 predictions for 2021.
Thanks very much, Cole. Hi, everyone. Happy New Year. Cole, thanks for reminding us about some of the long-term principles. Congratulations on the excellent performance. And I will tell the viewers that my macro thoughts are very consistent with OneAscent's portfolio positioning. So let me get into those details by first reminding us a little bit about what happened in 2021 as we try to get the slides going here. Okay, Cole, we don't seem to have control. Have you passed that on? Oh, maybe you have. There we go. This is a crude reminder of what happened last year from an asset return standpoint for the full year 2020. You see the caption, "A topsy-turvy year ends A-OK." Someone said if you were Rip Van Winkle and went to sleep on January 1st, somebody woke you up on December 31st, showed you your return, you'll say, another pretty good year. I guess it was kind of boring and quiet. When you all know, while the averages did end up in reasonable shape, it was anything but dull and boring with all kinds of consternation in between. Okay. So here's one reminder about last year. I'll never forget how in early March the consensus view of global GDP was plus 3%, and by the middle of April it was minus 3%. That 6% swing is the biggest swing in history over any time frame. As the title of the slide says, the unanticipated coronavirus crisis changed absolutely everything, and some of the sad reminders of what it did change are on the right-hand half of this slide. Here's my summary slide. Again, as you know, and as Cole mentioned, I'm a U.S. large cap portfolio manager, and so the lens from which I view everything, at least on this planet, is through that of the U.S. equity market. So my overview has to do with that. Don't take the preciseness of these numbers to heart. They're meant to be suggestive of a direction. And what I'm arguing here is that the economy and earnings are likely to have a very strong year, and the stock market's likely to have a good year. Distinguishing between the two has everything to do with the bottom left in the slide. The big tailwind is the reopening of the economy. Thank you, vaccines. It will take some time. It won't be a straight line. We're already seeing that. But a recognition, number two, that Americans have saved approximately $1.5 trillion above normal. That's come from three sources. One, checks from the government. Two, a desire to spend some money, but inability to do so because whatever it was is closed. Or three, not spending money because people were scared, stayed at home and under the covers. And those three things have accumulated to repeat $1.5 trillion. Some of that, as the economy reopens, will get spent, and that will aid to the tailwind. Finally, rebuilding of inventory. Inventory is pretty lean in the system, and when you build inventory, it adds to earnings. So that's the good news. Let me throw a little bit of cold water on it to say that I don't think that stocks will keep up with those strong earnings. We're arguing, as you see, for earnings up 21%. We made that forecast when we did these predictions in December. Now that we have two Democratic senators from Georgia, a much higher probability for yet another stimulus/aid package, that earnings growth is likely to be higher than 21. 25 on a good day, maybe 30%. So I'm arguing stocks might go up half as much as earnings, something on that order of magnitude. The reason is we think valuations will struggle a bit this year as interest rates slowly but surely rise and inflation slowly but surely rise. Not to onerous levels, but up from nearly zero, if I can say it that way. The price-earnings ratio for the stock market, right-hand half of this slide, is in the 96th percentile, meaning it hasn't been more expensive than this very often. Now, just because the stock market is expensive doesn't mean it goes down. You saw Cole's four-quadrant view of how to look at the market, and I concur with that. Valuation is important, but other things are as well. And so we think, to repeat, great year for the economy and earnings, a good year for stocks. So with that in view, let me more quickly now take you through these 10 predictions, provide a few conclusions, and then if there are any questions, take those. The first of which is U.S. real GDP increases at its fastest pace in 20 years. The consensus is expecting 3.8% real GDP this year. We're at 4+. In fact, it might even be 5%. The strongest growth we've seen in the last 20 years was 20 years ago, 2000 at 4.1. I think we will exceed that, and that we're likely to have the strongest U.S. economy in 36 years, the strongest growth since 1984. On the right-hand half of this slide, you see that we peaked prior to the pandemic and the associated recession in the fourth quarter of 2019. And we expect by the middle of this year, second, maybe third quarter, real GDP will hit a new all-time high, meaning we will have erased all of the effects of the recession. That doesn't mean every industry is back to where it was. Some have gone far past where they were, and some are still lagging, but the overall economy to achieve a new all-time high. What are the sources behind that? Here they are, the economic building blocks from our point of view. I won't insult your intelligence by reading them all to you, but let me just point out a couple of them. Very low interest rates, the lagged impact of 4 stimulus plans. There's still billions of unspent dollars from the stimulus plans that have already been passed. Who would have thought that in the middle of a deep recession, we begin an absolutely incredible housing boom on the back of very low interest rates and refinancing activities? The vaccines opening up our economy, as I mentioned earlier. Improved productivity, that's an important one. As the pandemic set in, Americans, both individually and as corporations, spent money on technology, and that has improved our productivity. Prediction 2. I'm struggling to move these slides for some reason. There we go. Inflation approaches 2% as the 10-year U.S. Treasury yield reaches 1.5%. Now, those numbers, 2 for inflation, 1.5 for 10-year Treasury yields, are the consensus forecast for next year. In other words, we think interest rates and inflation will move up faster than the consensus does. In fact, you see on this slide how out of many dozens of forecasters, only 4 said that we'd have more than 1.5% 10-year yields. We think rates and inflation will go up a little faster than forecast, and here are the 15 reasons why. Some of these relate to inflation, some interest rates, some to both. Again, let me point out a few of them. First of all, the Fed, the Central Bank of the United States, used to have a policy where they said 2% is the peak inflation rate we will tolerate. They have changed that to be we want inflation now to average 2%. So if inflation spends some time at 1%, it needs to spend some time at 3% to average 2%. That's a huge change. Inflation expectations, the commodity price increase are all tailwinds for this prediction. One of the predictors of inflation and rising interest rates is number 6, the behavior of cyclical versus defensive stocks. And that in the last few months has registered interest rates and inflation will go up some. In fact, we've seen some of that. Many of you know that the 10-year Treasury yield closed 2020 at 0.93%, 93 basis points. As we speak, it's 109 basis points. So it's up 16 basis points, having already been actually at 117 basis points before bonds had a bit of a rally here. So we think interest rates and inflation will move irregularly higher. Prediction number 3. Of all our predictions, this is the one that is most consensus. It is the U.S. dollar sinks to a 5-year low. Now, the dollar has been oversold in our view and is actually having a bit of a rally. We think there's more rally to come, but then it will resume its decline. Why? Bunch of reasons. I'd say it this way. The macroeconomic imbalances in the U.S. For example, the current account deficit, the net national savings rate. These are troublesome in terms of expectations about currency. In fact, let me make a broader statement about the economy, currencies, and markets. The United States economy and stock market is one of the most defensive the markets and economies in the world, implying we have fewer cyclical areas than most other countries. So when you think about a decade that we've been through where economic growth was some years okay, too many years disappointing, that's an environment where defensive things do well. So it's no secret why the US dollar was strong, why the US economy was stronger than the rest of the world, and the US stock market outperformed. We are in a reflationary period whereby central banks all around the world and governments are attempting to reflate their economy on the back of the pandemic-induced recession. The first place that reflation activity goes when interest rates get lowered and money gets spent is into the financial markets. And that's why the stock market, with 2020 hindsight, went straight up after the low last March, even as earnings estimates were being cut. Valuations, PE ratios, went much higher very quickly. Stocks were selling at 13 times earnings at the low last March, causing us to pound the table for the stock market. PEs are 10 points higher than that now. Why did bonds go straight up and interest rates go straight down? Answer, reflation. Now, and in recent months, we're beginning to see, and we will see more of it as the vaccines come through, that reflation moving its way to the real economy, benefiting non-US more than the US, currency, economies, and markets. Doesn't mean the US stock market's going down. It just might mean it's going up less fast than these other places. Number 4. Stocks reach a new high for the 12th consecutive year, but fail to keep pace with strong earnings growth. Pictured here is the S&P 500 high in each of the last bunch of calendar years. And you see, starting in 2009, every year we made a new high. We've already done it for 2021. But we think, as mentioned, stocks will fail to keep pace with those strong earnings growth. Price target for S&P, in our view, is $39.50. Never take anyone's forecast with any precision. We think it's up modestly. To repeat, earnings growth is going to be great. You see in the middle central, we think revenues will be up 8%, margins up a whopping 12%. Stock buybacks will re-enter the equation, giving us a total earnings gain 21+%. Prediction number 5. One more comment, valuation. A lot of people are concerned that stocks, quote, are expensive. Well, they are versus history, but they're not necessarily relative to our alternatives. Pictured here at the top 2/3 of this slide are absolute observations. For example, we looked early on how the forward PE, price earnings ratio for the stock market, was in the 96th percentile. Market cap to GDP, 100th percentile. Cash flow yield, 93rd percentile. Relative to history, stocks are expensive. But that's an academic comment. Nobody can buy stocks today versus yesterday. Make your choice. Do you want to buy them 10 years ago or you want to buy them today? You either buy stocks today or you buy something else today, and therefore the relative is important. We show here the stock market relative to investment-grade bonds and 10-year treasuries, and you see the percentile is much more reasonable. Prediction number 5, hopefully consistent with all I've said, stocks beat cash and cash beat bonds. In other words, when the year is said and done, we think the order of finish will be stocks first, cash second, and bonds third. For stocks to beat cash, they actually don't have to do anything. The stock market has a higher yield than cash, and so if stocks are unchanged on the year, they will have beaten cash. For cash to beat 10-year treasuries, the yield on the 10-year treasury just has to move up a basis point or two, which it did at the opening on January 2nd. If this is the order of finish, it'll be the first time in 8 years. Prediction number 6. As interesting as the economy and earnings in the stock market are, the real excitement, in our view, is what's happening inside markets. To illustrate that, I've taken a 3-month period from around Labor Day to around Thanksgiving and showed you what happened. The S&P 500, we chose this period for this reason, was identically unchanged, zero return. It bounced around and went nowhere. But during that roughly 3-month period, high beta stocks were up 20%. Small cap stocks up 14, mid cap up 11. Do you see in part why OneAscent's asset choices have done well? Japan up 10%, emerging markets up 9%. Now, if the market's unchanged and some things are up, other things have to drag it down. In fact, technology was down 6%, the NASDAQ 100, which has a lot of tech in it, down 4%, Treasury bonds down 3%, do you see? If we look at this same kind of concept on a longer term basis, I call your attention to the 10-year row, the bottom row. You can see in the last 10 years, stocks did well, but growth stocks beat the pants off value stocks. Large clean the clock of small cap and U.S. handily beat non-U.S. Our view, because of the reflation comment I made a few minutes ago, is the baton is being passed from growth to value, from big to small, from U.S. to non-U.S. It doesn't mean run out and sell all your U.S. large cap growth stocks. It just says make sure you have a balance of other things in your portfolio. Number 7, our favorite 2 sectors, healthcare and financials. Healthcare is always interesting, especially in an election year, and it underperformed last year. But we find healthcare stocks now pretty inexpensive relative to their reasonably good prospects. The possibility of some government intervention on pricing of healthcare products is there. We've got to watch that carefully, but we think this is a sector that will work well this year. Financials are our favorite cyclical sector. We've had a multi-year period of financials underperforming, but with reflation happening, loan growth improves, net interest margins are already improving with the increase in the slope of the yield curve, and to repeat, they're pretty inexpensive. Prediction 8. One of the questions I get asked very often is, what about the debt and the deficits? Aren't they going to do us in? And my answer is, it might do us in at some point, but not yet. First of all, an observation or two. This is not the first time in the United States that we've had debt cross 100% of GDP, as it is likely to do this year. It happened post-World War II as we financed that war, and of course, we took care of that largely by growing our way out of it. Forecasters, and sadly I'm in this group as well, don't think we're going to tackle it as quickly. But why has this not yet mattered? Next slide, I think, answers the question. Yes, debt and deficits have gone extremely in an upward direction, but they've gone up slower than interest rates have gone down. And as a result, I'm pointing to the black line now, interest expense as a percentage of our economy, as a percentage of GDP, has actually gone down and now flattened out. It is only when that line goes up noticeably does this begin to become an issue. And it'll go there. We are borrowing from the future. I'm not meaning to say this is a non-issue. It's a big issue, but not today. Prediction 9. The U.S.-China Cold War continues, but the conversation becomes quieter and more multilateral. President-elect Biden, soon to be President Biden, has suggested that he's not going to make any immediate moves on China till he develops a strategy, and that will be to get our allies on the same page. By contrast, as you remember, President Trump attacked this more in a unilateral way. We'll see how this new policy works. Either way, China, in my opinion, remains by far the #1 national security threat to the United States. China has stated privately and publicly that they intend to dominate the United States and the planet economically, technologically, and militarily. This is a big threat for the United States, and it will be a challenge no matter who's in the White House, and this will last, this Cold War with China, for years to come. We pray to God it remains cold and never becomes a hot war. Finally, number 10 is always a political prediction. There's no election this year, so we're focusing on legislation. Despite polarization, and you know we've got plenty of that in our country, we think despite that, President Biden, Senator McConnell, and some moderate forces will achieve some compromise legislation. Several points to make as to why we think that's possible. Number one, you'll recall the Congress passed and the President signed, after many, many months of deliberation in late December, an aid package for COVID. Who revived that bill? The answer, the moderates. About 8 moderate senators from the Democratic and Republican parties and about 50 House members came together and said, we got to get this thing going. With a 50-50 tie in the Senate, with a modest lead in the House, it is the moderates that are likely to set the agenda and be able to get things done. The second reason we think this is possible is to recognize there's an important relationship in Washington that's not gotten enough attention. That is the friendship between Joe Biden and Mitch McConnell. They've known each other for decades. They sat in the Senate for decades together. I'm hoping we hear that the two of them privately had breakfast, lunch, and dinner from time to time, and I know what will be happening. The president will say to Mitch McConnell, okay, what do I have to give you Republicans to get this done? And Mitch McConnell will say, Mr. President, if you only do this, we'll come along with you for that, and we'll get some compromise legislation done. Next slide shows what I think that legislation might look like. If I can get it to move. Cole, can you help me? I just can't get it to move. Well, while we're waiting, let me make a couple comments. It is not what the market feared. You might remember the stock market in September went down a lot. The week before the election went down another 7%. The reason the market sold off, it was fearful of a big blue wave. The Democratic platform proposed $4 trillion of new taxes and $6 trillion of new spending. That was assuming a big blue wave that we'd have 53, 54, maybe even 55 Democratic senators, and the number is 50. And as a result, a lot of this legislation is not going to be as extreme. We might get some things like another aid package. We might get some modest tax increases. If I'm a corporation not paying much tax, I'm worried. High income and high wealth individuals probably going to pay more taxes. We might get some infrastructure spending. So those are things that we think will make a difference here in 2021. So unable to move the slides, let me just make a couple of concluding comments, and then we'll see if there are any questions. Conclusions, I've got 10 of them. Let me try one more time to move these slides. No, they're not moving. So let me just go through these conclusions. 1, the economic and earnings outlook has definitely improved. 2, an orderly vaccine rollout is the key to any positive outlook. 3, inflation and interest rates will move higher. The question is not direction, the question is pace. 4, stocks are likely to appreciate but less than earnings. 5, within fixed income, preference for credit spread and where appropriate muni strategies over treasuries and sovereigns. 6, the dollar's path of least resistance is lower. 7, commodity prices are likely to continue irregularly higher. Yes, we like gold and silver, but we have a preference, even though they're overbought in the near term, for industrial commodities. 8, China remains the biggest driver of global growth based both on its size as well as its growth rate. 9, my biggest intermediate worry is central bankers and fiscal authorities overstay the reflationary efforts, eventually inviting an inflation that none of us wants to see. And number 10, because starting valuation points for stocks and bonds are high, it is likely long-term returns on our portfolios are becoming more challenging. We are unlikely to see in the next 5 and 10 years what we enjoyed in the last 5 to 10 years. Finally, let me comment on some longer-term trends. There are 3, I think I've identified them on these calls before, that are secular trends in place, accelerated during COVID, and will continue thereafter. They are deglobalization, digitization, and online shopping. Everything else is up for grabs and discussion. Remembering how most things reverted back to normal post 9/11, my guess is in the next 2, 3, 4 years, most other things will revert back to normal. Yeah, some of us will work from home, but far more of us will be going back to the office. Not everybody's leaving the city. Some will move back in. These are temporary based on some of the issues that we face because of COVID, but we think a lot of them, it'll take months, will revert back to normal. So there are our views. Cole, I'm going to turn this back to you and see if we have any questions.
Great. Thank you, Bob. We apologize for the technical difficulties. It looks like the screen is frozen on a previous slide and was not able to advance, and I've not been able to get to do so either. So I apologize, but thank you for finishing. We do have a few questions. If you can, if the audience can ignore what's on the slide, we'll talk about our questions. Bob, the first one is about sort of what's happening tomorrow. Now that we know that Democrats are controlling the White House, Senate, and the House of Representatives, does that yield bigger shifts in policy, potentially opening up more uncertainty? We've heard the phrase that uncertainty, markets hate uncertainty. Sort of what does that look like in terms of potentially derailing investor confidence, leading to selling, market volatility? Would you mind sharing sort of your thoughts on that?
Certainly. I would argue the election has reduced uncertainty. Take me back to November 1st. We didn't know who was going to be the president. We didn't know how many seats will be in the House or the Senate. Now we know. We have reduced uncertainty. So we can narrow the potential set of outcomes significantly. And that's a good thing for the markets. Now, we could debate, is the policy good or bad for markets? And there'll be some of both naturally, but uncertainty has definitely been reduced.
Thank you, Bob. I know you touched on some of those policies. That may have been the slide that we weren't able to see. Would you mind, now that uncertainty is reduced, we do have a tighter set of potential outcomes, maybe speaking again, kind of reiterating what that might look like for the market?
Certainly. So what we know we're not going to get that markets feared with those 2 sell-offs I referenced is a big Green New Deal. The massive spending and tax increases. It doesn't say we won't get some spending increases and tax increases, but not that what was feared with the big blue wave. Now, we have to face the facts that the Democrats do control the House, the Senate, and the White House. So there are issues that, in fact, they will have their say on. But I'm going to repeat, the moderates will have to say yes in both parties to get that done. Remember, the consensus was that Joe Biden would win the presidency, and of course that happened. The consensus was that the Republicans would lose 10 to 15 seats in the House. They gained 12 seats. The consensus was the Democrats would end up with 53 or 54 seats in the Senate. They ended up with 50. So a long-winded way of saying the big progressive agenda, unlikely. Pieces of it for sure. As mentioned, we'll probably get another aid bill that we might not have gotten had the Georgia not gone 2 seats in the Democrats. We might get a modest infrastructure bill. We could get, as mentioned, a modest tax increase. Maybe some legislation around restructuring student debt. One of the things both parties generally agree on is policy around China. We'll get some things there. Could we get some drug price reform? Could we get some immigration legislation? These are all possible. The list, had we gone to that slide, I put roughly 1 in 3 chance for each of these. Some are 1 out of 10, some are 50-50, but these are the kinds of things that we may see over time.
Thank you, Bob. That's helpful for us just to kind of frame up what we hear potentially on the news and kind of tying that back to how it maybe impacts markets.
What I should have said also, Cole, sorry to interrupt you. What I should have said also is the progressive agenda that was feared by many, including the market, and those sell-offs, was the end of the filibuster, which could still happen, but much longer odds. Packing of the Supreme Court, statehood for Washington, D.C. and Puerto Rico, reform in the Electoral College. It's not a zero chance, but it's much lower than was feared.
Great. Thank you for clarifying that. Our next question goes back to valuations. You mentioned, and sort of one of your predictions was that stocks would outperform cash and cash outperform bonds. You touched on the absolute versus relative performance. Do you mind expounding on that just a little bit, giving some of the historical context? We have clients who work with our advisors who this is their nest egg, and it's what they've got for retirement and for all the things that they're planning. How should they think about that in a historical context? Maybe unpack that relative concept again, and just sort of explain sort of, if you've got new dollars to put to work, where's the most likely place to do that?
Well, given our view, again, I'm going to be short term, stocks first, cash second, bonds third. That partially answers the question. I would, again, I'm all my comments were kind of this year, 2021, and next year in some cases. We didn't talk at all about the long term. That's the first place these people should focus. What are they trying to do long term with their money? You know that. You stated that up front, Cole. What I would say is for this calendar year, given the way we see the world, stocks are going to be bumpy, but they're likely to go up. Remember, look, if your time horizon is 1 year, stocks are the wrong place for you to be, because about 1 out of every 4 years, the stock market goes down. And, stocks and other risks assets, you need a longer term time horizon. And so in that valuation slide, I was trying to respond to those who say stocks are expensive at a PE of 22, when on the long term they sold at 14 or 15. Well, they have, but when interest rates and inflation are low, which they are, PE ratio should be high, and that's why I brought the relative valuation argument in to argue stocks are not cheap, but they're certainly not expensive relative to my other choices.
Thank you, Bob. Well, again, we apologize for the technical difficulties. Not sure what happened there. We'll get that sorted out and correct that for our next call in April. Bob, as always, it has been a pleasure. I always learn something new every time I hear you speak. I'm sure our audience does as well. Thank you for the time. To our audience, thank you all for participating with us this morning. If you have questions about OneAscent, would like to speak to an advisor, again, you can use that email, info@oneascent.com. We have lots of resources we'd love to share with you. A recording of this call will be made available, fact sheets, our allocation dashboard, other resources about our investment solutions. So again, I want to thank Bob for his time. We appreciate your partnership, Bob. And to our audience, thank you for making time with us this morning. That'll conclude our call, and you may now sign off.